very happy to present to you today the quarterly capital markets and economic perspectives. And per usual, this is going to highlight a variety of insights that we're making on the investment committee. And the idea is to make it somewhat accessible so that our clients and the advisors we're working with can actually understand what we're doing and what we're not doing, where we're allocating, where we're not allocating. You know, the markets have been incredibly volatile. And so I think times like these are when people actually enjoy getting these updates. And so we're very happy to do it. And with that, I'll go ahead and dive in. The first slide is disclosures. All of this is to say is past performance is not indicative of future results. Be sure to consult with your financial advisor. And you can pause this if you're looking at a replay or give us a call and we'll send you this slide so you can read it in detail. If you want to stay informed along the way, there's a variety of outlets that we are publishing on, whether it's my monthly Forbes articles that usually are touching on some kind of economic issue, or on Fast Company, talking more about financial advisor issues, on YouTube, where this particular update will be available. Also Instagram and Twitter. We're on all the things. Along the way, if you have any questions, please don't hesitate to type it in. There should be a little Q&A button that you can tap on, and at the bottom of the top of the screen, or however you have it set up on your system, and type it in. I'll see it pop up as a window on my end. And I'd like to address it as we go along. And of course, if time allows, we'll have further Q&A. This whole session is only 30 minutes. So there's a number of bits that I want to get through and make sure we hit on everything. And so I may go at somewhat of a fast pace, but that's all in an effort to get everything out to you. Also, for those that don't know, we do have an independently verified benchmark beating performance, particularly in the past 3 years. We've been beating our benchmarks by several hundred basis points, which is something we're very happy about. But of course, we never know what comes next in the market. And so that's exactly why we share these perspectives with you, so that you're very informed and you understand exactly what our positioning is in the portfolios, but also what our rationale is and what our thesis is around these decisions. And so we've made a little box on several of these slides that you're about to see that calls out the specific portfolio positioning or rationale as to why that particular insight is being highlighted. And so I'll make special mention of those, and that way for our clients who are joining us, it really takes the mystery out of, okay, this may sound really cool and interesting, but what does it actually mean for my portfolio and how we're positioned? So the first thing that I'd like to highlight is something that's a bit of an oddity and something that certainly struck us as quite dramatic. And you can look at a chart and not know anything about what is represented here and see that there's something that's very dramatic that happened sometime in 2023. And that is the amount of shares that are short in the S&P 500 has skyrocketed. It essentially has nearly tripled from a prior 5-year average. That is significant and something to be very cognizant of. We certainly look at this as a very bearish indicator. There's quite a bit of negative sentiment out there. If you are short a stock position, it means you're betting that the price is going to go down. So this is a lot of institutional money, a lot of hedge fund money that's positioned in this way, and very important to know that this is out there. Certainly volatility that we've been seeing this year so far indicates that maybe this is a very prudent way to be positioned. And so for our positioning, we are certainly underweight U.S. market cap leaders, specifically those Magnificent Seven. We have 0% exposure to the S&P 500 from a market cap weighted standpoint. We have exposure in our client portfolios in a equal weight, but not in market cap. So we're very concerned about the market cap leaders, and this particular short data is part of that thesis as to why we want to make sure we really limit that exposure. And if you've attended some of these quarterly meetings in the past, you've heard me refer to the Magnificent Seven as the mediocre seven. And that continues to be the case. If you actually look at the past 3 years, the Magnificent Seven actually looks more like the Magnificent One. There's really only one company that stands out, and that's NVIDIA, with a 270% return, which we think is completely overdone due to the AI craze and euphoria that's been sweeping through the markets, and certainly that's been lifting other companies like Alphabet and Apple and Meta. And but you can see, if you look at a 3-year time frame, Tesla is actually negative nearly 13%. And this is, of course, through January 5th. So there's been more negativity since then in certain of these stocks. Alphabet up 53%. Amazon's actually negative 8%. So, it's always good to look at a wider context than just trying to look at one particular year and see, oh, wow, everything's been doing so well. Well, actually, you step back a little bit and you see that there's been, these annualized returns aren't actually all that impressive, especially when you look at Amazon at negative nearly 3% per year, or Tesla at negative almost 4.5% per year. And, we always like to read the research of other companies. We do our own proprietary research, and we're reading a lot of originated data or first published data, whether it's the Fed or other economic writers. But we also like to see what other large institutions are thinking. And, Goldman Sachs is a big institution. Everybody knows the name. And, they're not seeing anything that is significantly different than what we are seeing in terms of this dominance of the Magnificent Seven, particularly when you're looking at the percentage of these 7 companies as a share of market cap. It's at 29%. And you can see in that particular peak here, we haven't seen anything like this in many, many, many years. So that's obviously of great concern. Anytime you see something like that, where you're just really out a couple of standard deviations from normal or average, that's worth noting and being aware of. Maybe not a lot more of upside, but quite a bit of downside in store for those Magnificent Seven who have been lifted. You can see, just looking at them for the year of 2023, up 71%, just those 7 companies, most of that being carried by NVIDIA. The S&P 500 itself up about 19%. Obviously, it closed the year up closer to around 25%. This data was run through about a week or week and a half or so before the end of December. And you can see the remaining 493 companies were up only about 6%. So this is a massive deviation between all these other companies in the S&P 500 up, mid-single digits, compared to the Magnificent Seven, which are significant double digits. You may see almost close to triple digits. So this has been the market. There's not been a lot of participation to the upside with most of the S&P 500 or most of the U.S. stock market. This is very important to keep in mind as I take you through the following slides. And something also, as we like to look at data that is representative of extremes, we're seeing that also in the mega cap tech shares of total U.S. hedge funds, single stock net exposure. And this is a percentage rank, and they've been doing this since 2016. And we can see that in January of 2022, there's about 56% of a net exposure in single stocks of these mega cap tech by these hedge funds. January of 2023 was only 12%. So many of these hedge funds actually missed out on that huge run of the Magnificent Seven. And then here, almost like, making decisions by looking in the rearview mirror, there's a 99% concentration within these net exposure within single stocks, within mega cap tech. So that is something certainly that I think is a fascinating piece of data. It just means that a lot of people that have run into that part of the market, maybe hoping that that continues to run. We're not in the camp that's thinking that that is going to be continuing to run. And here's one of the reasons why. This is how the Magnificent Seven looks to us. And, we look at everything through a fundamental lens. And we want to be investing our clients' capital through the lens of fundamental understanding of how stock prices are determined. And at its very basic level, a stock price is simply the present value of all future earnings for that company. And so if we look at earnings per share on a diluted basis over the past 5 years, a total cumulative growth of earnings per share of these Magnificent Seven companies versus companies that are essentially in the top 10 of our typical equity exposure, we can see that, actually Johnson & Johnson has had a 70% earnings per share growth over the past 5 years, compared to the top of the heap on the Magnificent Seven is 38%. And I can tell you, Johnson & Johnson did not have a huge up year last year. Really, none of these companies had a big up year last year relative to these Magnificent Seven. So there's some big disconnect that is happening in the marketplace between fundamentals, which are truly what should be referenced when driving stock prices. And ultimately, we believe that is where the reversion back to the mean occurs. And so these huge deviations for the seven is a bit of a peril, in our opinion, and certainly driven by the AI euphoria, and continues to be lifted a bit. And so from that standpoint, we prefer an overweight in small and mid-cap US equities, continuing to stay away from these market cap leaders. Certainly we have large cap exposure within the portfolio, but we're doing that in an equal weight, which ultimately ends up giving more diversification within the portfolio and insulating the portfolios from big crashes that may occur within this particular Magnificent Seven part of the market. There was a research highlight that I published in November of last year, and it is worth looking at if you haven't. And here's the highlight here, which is we've basically seen a return in our economy to average interest rate levels. This first chart here shows the effective federal funds rate, which is the rate that the Federal Reserve manipulates. We've seen that the average going back all the way to the mid-1970s has been around 4.65%. Right now, we're around 5.3%. And then 30-year mortgage rates, going all the way back to the mid-70s, I mean, a lot of time has passed since then, around 7.67% is the long-term average. Right now, call it, 7.7%. So we're almost spot on for where long-term averages are over all kinds of economic conditions and all kinds of recessions. And then the spread between 10-year Treasury yields and 2-year Treasury yields, we're still inverted right now at a negative, basically 20 basis points, 0.18%, which means the 10-year is actually lower right now than the 2-year Treasury. So this is an inversion of the yield curve, very unhealthy that persists for as long as it has. The long-term average is closer to 1% or 100 basis points. A long-term average at 88 basis points. So we're nowhere near this. We're about 100 basis points away from this. And then the 10-year Treasury long-term average is 5.87%. Imagine that. 5.87% is the long-term average. And right now, we are at well, this says 488. So since this was run in November, boy, has this come down quite a bit. Today, we're sitting at around 4% on the 10-year. So a return to average is good. It's actually very healthy for the capital structure of companies. It's healthy for investors. It's just a bit of a bear, literally, no pun intended, getting through this part of the cycle to to the other side of it. So there's a lot of volatility and a lot of adjustment that occurs with market participants, and something certainly to be prepared for in our client portfolios. Here's another thing that certainly is a red alert in our book, which is looking at risk-free yields. We look at the 10-year Treasury rate, which is a risk-free rate of return, versus the earnings yield of the S&P 500. And we can see currently that, and this is still holding to this day, that the 10-year Treasury is actually yielding more than the S&P 500 in terms of earnings yield. Earnings yield is simply the price earnings ratio turned upside down. So it's earnings divided by price of company. And that's sitting at around 3.25%. Usually when you see that yield is better in one security versus another, it means one is more attractive than the other. And it's kind of a normalizing metric to look at. And we certainly can see that since really, 2022, there's this crossover point that occurred and really has held up. So certainly last year, the stock market's been behaving as if this does not exist. But certainly the fundamentals of those companies that have been performing so well are not impressive. And they haven't had earnings growth in any impressive way that would be so magnificent. So we're really very disciplined in understanding that there is a market dynamic at play here that requires monitoring and making sure that portfolios are positioned accordingly. This spread is something absolutely that we're keeping an eye out on. And as a result, we're favoring fixed income securities over equity securities of any kind. Doesn't matter if it's US large cap or small cap or foreign equities. Specifically, when we look at cash, stocks, and bond allocation, we are significantly underweight in our equity position. If we have a neutral weighting at 60%, currently we're at 50%. So a full 1,000 basis points or 10 percentage points below our neutral weighting. So this is how much conviction we have around this particular issue, which essentially means that fixed income is a better buy. And, even looking at the lowest rated investment grade corporate debt that's out there in the marketplace, you can see that it's hovering around this very low spread value of 1.34. You look back over the past 5 years and it's, very much at that lower level. Spread is an important indicator that essentially showcases risk and how much risk perception there is in the market. With all of this debt, trillions of dollars of corporate debt, higher interest rates, refinance risk, all of these things at play, you would think that you would see higher spreads and that there would be some risk that is baked into the market. On the contrary, you do not see the markets worried at all. We don't understand how that can possibly be, other than the euphoria from AI has spilled over into every other part of the market, and people are absolutely myopic, only looking at what's going on financially in the next quarter or next week, frankly, and not really understanding the impact of many of the risks that are still embedded in the marketplace from higher interest rates and what that actually means for companies. So certainly for us and our client portfolios, it means not being compensated to take on credit risk or duration risk. So we don't. We are in very high grade paper, AAA, A, AA type paper, government debt primarily, some corporate debt, but only very, very high grade. And we're not taking duration risk. We're not going out 5 years or 7 years or 10 years. We're staying very much on the short end of the yield curve, where we actually believe there will be some upside opportunity, even from a capital growth standpoint, if there is a flight to safety, if there is real panic that does sweep through the equity markets. And that will serve as a very, very effective hedge in our total portfolios. And, as if it isn't enough to be very clear about how big of a problem this is, just in the past 3 years, all of this debt, looking at the past decade, half of the debt that's been accumulated has essentially come over the past 3 years, during a period of extremely low interest rates. You can see here, hugging 2%. So imagine all these companies that were financing in 2020 and 2021, which there were a massive amount of refis occurring during this period at 2%. Well, a lot of that debt was 5-year paper. And so we're going to be seeing these refi, a lot of maneuvering that CFOs are already planning on from those that didn't refi during this period of time. Because the long-term average was 3.86% over the past decade for triple B yields. So very, very, very low relative to what we're seeing now, which is around 5.5. So there's absolutely some pressure here that CFOs are feeling, and of course that trickles down throughout the economy. And so this debt colossus grew during this well below average cost of financing, and that's just not a sustainable trajectory. Also, we've seen a jump in U.S. convertible debt issuance. And all of this is to say that CFOs are actively maneuvering. They're looking at a variety of options that are available in the marketplace. There are big names and big blue chip names that are actually going to the convertible market with essentially net zero interest rate costs and taking advantage of that, or 1% interest rate cost with convertible options if certain prices of the stock are hit. And so obviously that is a highly dilutive impact to shareholders, and something that also makes us a bit bearish, particularly when it comes to these large cap US companies, which are the ones that binged most on this very, very cheap debt. And we look at this as a total assets of the Federal Reserve. You can see that it's crested somewhere around 2022. It kind of bumped up a little bit during the Silicon Valley Bank issue, but it's come down from close to 10 trillion of assets held by the Federal Reserve banks down to around 7.7 trillion. So that's actually a very nice improvement. The only issue is that money supply has not moved in lockstep with it. It's still hovering at really high levels. It's come down a little bit. And this is something that really is a concern, because we look at this as a mean reversion possibility. And of course, how do you have something get back more? How do you get money supply more to long-term average? You really need capital destruction to occur in order for further money supply to contract. And that means things like defaults, bankruptcies, debt compromises. We haven't really seen a huge volume of that at this point. And so that is something to be, that we're certainly on the lookout for. Weekly economic activity, it declined precipitously over the past couple of years, and it's certainly spiking up quite a bit recently. And at the same time, inflation also in lockstep with weekly economic activity has been falling, and that's a sensible decline. What's so interesting, though, is that inflation, which is really a backward-looking item, and we don't get that print but every month, weekly activity gives us much more indication. So when you see this divergence between activity and inflation, it may indicate that we have not declared a full victory over inflation. And this could be a bit of a persistent nag to the Federal Reserve, which means rates remaining much higher for much longer. The Central Bank of Australia, the Reserve Bank of Australia, they have a lot of very interesting and transparent data to share. And one of the things they actually say on the website is that it can take between 1 to 2 years for monetary policy to have its maximum impact and maximum effect. And so in March of this year, we're coming up on 2 years with the U.S. Federal Reserve Bank implementing and beginning their monetary policy restriction. So this is going to be a very interesting couple of quarters, Q1, Q2. You may see some kind of credit event or some kind of shock. Global capital flows matter, and certainly what we've been seeing in the U.S. is a continued trade deficit. And since the pandemic and in the recession, we have been above the long-term 10-year average on a trade deficit. So a lot of money is being shipped outside and away from this country, but at a higher rate than before the pandemic. And that is not particularly great for the US dollar in a trade sense. And so this is one of the areas why, reasons and thesis that feeds into why we are overweight non-US equity and debt. Although at this point we haven't allocated to non-US debt, but we are open to that relative to US debt. Certainly an overweight to non-US equity. And then US dollar value megacycles. Let's look at what the dollar has done over a period of decades. Certainly had a nice big upcycle during the 90s into 2000, from 2000 to 2010, plummeted relative on a trade-weighted basis, and then has been climbing since 2010 all the way through some recent times where we begin to see some of a decline. But so what's really more likely, or what's likely next, is continued reversion upwards and further growth with all of this backdrop of restrictive policy, fiscal issues, elections, trade. And we're more in the camp of thinking that it is a prudent thing to have more diversification and overweights towards non-US equity assets. And certainly you can always learn more about our 4 core strategies. If you're a client, you're likely in one of them. And we're happy to provide more information to you on any of those strategies. And thank you so very much for your time. And with 3 minutes left in the 30-minute promise, I'm certainly open to any questions that you may have, if there are any questions. I haven't seen any queue up during the presentation, but if you happen to have any questions, please ask them now. Well, please feel free to send us any questions to our personal emails if you're a client, you have them, or generally at info@alignwealthllc.com. And certainly we'd be happy to have further discussion. Thank you very much for joining me today, and look forward to having you join us next time.